Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and today we're going to be spending some time in Tactica's IRR waterfall distribution model, and we're going to convert it to an XIRR version. But before we get started, we're going to talk about the differences between Excel's IRR formula and the XIRR version. We're also going to get into why I think the XIRR is superior as a reevaluation metric to the IRR. I also have a written tutorial showing you how to do this conversion. If that's more your thing, there's a link below that will take you directly to the Tactica website, and you can follow along from there. If you're enjoying this commercial real estate content, I'd really appreciate if you like the video, give me a follow, and turn on your notifications. Let's go ahead and get started. For many investors, the internal rate of return, or IRR, is the preferred metric when evaluating real estate. It's a total return metric, meaning that it's accounting for cash flow growth, asset appreciation, paying down the principal balance of your loan, and it also factors in time value of money. So not only is it accounting for every dollar flowing in and out of the project, but it's also accounting for the timing of those cash flows. The IRR formula in Excel specifically is great for consistent cash flows, periodic cash flows. Many times when we're underwriting our prospective deals, we underwrite on an annual basis. We first figure out what the initial equity investment is going to be. We forecast cash flows along the way. Maybe there's a refinance, and then we'll have a residual sale assumption 5 years, 7 years, or 10 years down the road. But the IRR formula is not great for uneven, inconsistent cash flows. It comes up short in that department and can't calculate an accurate IRR return if cash flows aren't anything other than annual. That's when the XIRR comes in. The XIRR is great for those uneven, non-recurring cash flows that we might see in real-life application of real estate investing. The XIRR formula is very similar to the IRR version, except it has one extra assumption. Along with the cash flows, the money's flowing in and out of the real estate project, we also would need to highlight dates. So now cash flows would correspond with dates, and no matter when a real estate investment pays out, the XIRR will capture that accurately. I think the XIRR formula's strongest and best use is when you want to reevaluate a project. What do I mean by that? Most people initially, when they're considering an investment, they're going to forecast cash flows. They're going to use the IRR formula because it's easier and more convenient. And realistically, we don't know what's going to happen in the future, so that's usually more than sufficient. But let's say you're a couple of years into the investment. You made your equity contribution, maybe you've seen some cash flow, and now you want to figure out how the investment's going to need to do in the future to hit those initial IRR projections that you had originally estimated doing your initial diligence. So to summarize, you have some historical data, meaning you've paid out yourself or investors for the last few years, but there's also uncertainty into the future on how things are going to shake out. The XIRR is great for this exercise. If you want to run scenarios on how future cash flows are going to look to hit your original return parameters you set out when initially purchasing. Let's jump into the tutorial now. Right now we're looking at Tactica's baseline IRR waterfall model, and before we begin converting this to be able to handle the XIRR, let's talk about the terms that are entered in. In the contribution section, we're assuming that the GP or the sponsor would contribute 10% of the equity required, while the LP would be on the hook for the remaining 90%. Then below that, we have various hurdles, 3 hurdles, and then corresponding IRR ranges, and then profit splits out to the right. If the IRR of the project were less than 9%, the GP and LP would be paid out commensurately with what they contributed to the deal. However, when the project starts to see success and gets above a 9% IRR, then there would be a profit split that would give the GP 25% of the distributions, while the LP would retain a 75% profit interest. If the project were to exceed 16%, then the third hurdle would be achieved, and the GP and the LP would split cash flows 50-50. So if we go to the section below, you can see the cash flows. You can see this project was initially projected as 5 years. The contribution was $4 million. There was a little bit of cash flow in year 1. Looks like there's a year refinance in year 2 where the cash flow gets up to over $2 million. There's some stabilized cash flow in years 3 and 4, and then a residual sale that took place in year 5. The project IRR is 22.12%, which would mean the sponsor would have achieved the third hurdle. The GP and the LP should be happy. The LP had an IRR of 18.7% and an equity multiple of 1.9, meaning they nearly doubled their initial investment in 5 years. But now let's imagine a scenario where this was our original pro forma from 3 years ago, and the project isn't going as well as we had initially hoped for. We made the $4 million contribution. There hasn't been a lot of cash flow. There was a refinance, but it was for less than the $2.4 million proceeds we had initially projected, and it happened later. And now we're sitting here and we're trying to figure out what would need to happen in the future to get close to these initial projections that we had originally estimated when we were doing our diligence on this investment opportunity. So let's get into the conversion now. We're going to be overwriting formulas. So whenever you're overwriting anything in a financial model, I always recommend making a copy of the tab. So I'm going to go ahead and make a copy, and I want it to show up just right before the tab we're currently looking at. So it shows up as IRR Waterfall 2. I'm going to rename it as XIRR, and I'll make it red so it pops and stands out. The first thing I'm going to do is just copy and paste this section as values. I'm doing this because it no longer should be pulling from the pro forma model. We have some historical cash flows that we are going to manually enter into this model and the corresponding dates that they took place. We also want to project future cash flows, and those cash flows might be different now than what we had initially projected. The market has changed. It's been 3 years since we initially did this pro forma. So paste as values, and then we're going to add a column. The XIRR formula requires a date argument, so it won't work unless we have dates that correspond with the contribution or the distribution. So I'm going to label this column as date, and now years don't matter anymore. We're going to have actual dates, so let's just call this payments. So we'll have, payment 0 would be the equity contribution, payment 1 would be a distribution, payment 2 would be a distribution, and there's always going to be a date that corresponds with that payment. As I mentioned, we're pretending we purchased this investment 3 years ago. So I'm going to just plug in 1/1/2020, and then I'm going to plug in some placeholder dates for now, but we're going to come back and adjust these later on. So I'm going to just put in 12/31/2020 was when ideally our first distribution would have happened. And to do this a little faster, I'm actually going to use a e-date formula where I'm going to grab the previous date and then add 12 months to it. I'm going to steal the formatting, and I'm just going to drag that down through year 5. So now we have some dates that we can come back later and adjust. Now let's go below. All of the logic for the IRR waterfalls is hosted in row 95. So if you hit this little plus sign, you can see all of the details, and we're going to need to make a few adjustments down here. The first thing, let's go ahead and copy and paste our column headers. And then I'm going to do a VLOOKUP that will pull the date that corresponds with each payment from above. So I'm going to say VLOOKUP. I'm going to grab the payment as the lookup value. We're going to pull it from this 2-column array up here, and we're going to lock those cells, hitting F4. And we want the date to pull. So that's the second column in this array. So I'm going to hit 2 and then just leave the last argument blank. I'm going to grab the format painter, and then I'm going to drag that down, and you can see all the dates then will autofill. So there's one big ticket change we need to make in this section so our model can account for flexible dates, and that's with the required return. I'm going to highlight that cell yellow. So in the current formula, it's a really simple calculation where it's just taking the starting balance, the $4 million of equity that were initially contributed into the deal, and it's multiplying it by this 9% we stipulated as hurdle 1 in our IRR waterfall. The problem is this calculation can't handle flexible dates. It's always going to calculate on an annual basis, and if we have inconsistent payments, that no longer does anything for us. So we're going to need to go in here and adjust this formula. If you're curious about the if formula and what it's doing, I give a very thorough explanation in the blog post that's linked below, but right now I just want to focus on the required return calc, and that's what we're going to be making in the if true section of the if formula. I'm going to be taking that 4 million and I'm going to multiply it by 1 plus this 9%, and I'm going to lock that cell. That's important, and please don't forget to do that. I'm going to close the bracket, and then I'm going to take it to the power. I'm going to add 2 parentheses, and I'm going to take the date off to the left of payment 1, and I'm going to subtract the date of the previous payment period. I'm going to close that bracket, and I'm going to divide by 365, and then the final step is just to subtract this 4 million back out. I forgot to add a bracket, it appears. It happens to the best of us. Hit enter. Notice the required return didn't change. It's still $360,000. That's because the dates are exactly 365 days apart. This additional section of the formula with the exponent taking the date difference here and dividing it by 365 is 1. So that's a great sign that this formula is working as intended. Now I'm going to take this formula and I'm going to copy and paste it 1 cell over. We need to make some minor adjustments. I forgot to lock the column, so we just need to slide these 2 arguments over to the dates. And then this is the argument for hurdle 2. So instead of grabbing this 9%, we're going to take the 16% instead. So once we update that, the errors go away, and then the 640,000 is present, and that's the same as last time. So now I'm going to take these 2 formulas, and we're just going to copy and paste in the required return sections below until we get to 2024. Notice it's 199,529 right now. Once we paste it, it jumps up to 200,000. Why would it do that? If I'm being honest, I racked my brain trying to figure it out far too long, but there's a leap year in 2024. So there's 1 extra day that Excel is now calculating in that annualized return. We can go ahead and close out the detailed IRR section and come back up to our main model. So now what we need to do is we need to change this IRR calc to XIRR. So I'm going to go ahead, I'm going to say equals XIRR, and we're going to grab the values, and we're going to grab the dates, and I'm going to lock these dates. And now we have an XIRR formula and put it in there. I'm going to go ahead and I'm going to copy and paste this formula for the GP and the LP, and I'm just going to turn these cells yellow just so it's obvious that we made this adjustment. So now we can begin playing with dates and distributions to see how the XIRR is affected. In this imaginary scenario, the initial refinance date that we had projected in our Proforma 3 years ago was to happen at the end of year 2, or 12/31/2021. But it didn't happen until fall of 2022. And while we have a $28,000 distribution here, there actually wasn't any distribution at all before the refinance took place. So let's go ahead and adjust this date to 10/14/2022 when the refinance took place. But the refinance was only for 1.75 million, not 2.4. And now I'm just going to delete this data here. I'm going to change the color of these cells to a darker color just to symbolize that these are our historical cash flow. This is what has already taken place, and anything we're doing going forward is just a projection. Maybe we're projecting that we'll be able to send out $200,000 on 10/31/2023. Obviously, the XIRRs are negative right now because we no longer have that residual sale proceed in the model. So that would be payment number 2. And then we want to start to experiment with what a sale would look like in the early fall of 2024. So we're going to say 9/15/2024 would be the ideal sale timeline. To do this intuitively, we need to grab some data from the actual model. So I'm going to, off to the right here, I'm going to make some labels. We're going to have a purchase price. We're going to have a sale cost. And we are going to have a loan paydown. Let's go look at what we had originally projected in our Proforma model. I'm going to hit equals here. We're going to go to the return summary tab. In year 4, if we scroll down to the residual sale value, we are projecting a 5.4 cap and a $19 million purchase price from a potential buyer. I'm going to grab that for now. And then sale cost, we had to make a sale cost assumption on the investment summary tab. This is what you'd pay your broker, deed tax, legal, those types of expenses that come up in a real estate transaction. So we are projecting 1.5%. So I'm going to come back here and I'm going to take the price times minus 0.015, and then the loan paydown. So in year 4, the principal balance of our permanent loan would be $13.4 million. And then the sale proceeds would be $5.375 million. So now I'm going to go back to our projected cash flows and grab this 5.375. So what we could do now, I'm going to highlight this cell yellow, is we can start playing with the sale price. So I'm going to put in 21 million to see what we would need to do to get closer to that 20% plus project return we had originally projected. And coincidentally, I just plugged in 21 million and that got it very close. What if the market's softer now, where the original 19 million isn't feasible now, and it would be more like 18 million? You can see that would have a pretty significant impact on both the project IRR and the GP and LP cash flows. In this case, the sponsor would not get into the third IRR hurdle. If we come down, again, expand these details we were looking at earlier, that upon sale, it would get into the second hurdle, but it would never get into the third hurdle. There's 0 distributions coming out of the third hurdle. Hopefully what you're seeing here is how powerful the XIRR is. We're looking at historical distributions that have taken place and contributions. So we have the negative 4 million and the 1.75 million happen. It's set in stone. Now we're able to project future distributions and see how it could affect that total project return and therefore affect the split between the GP and the LPs. The inconsistent, uneven cash flows don't matter anymore because we're using the XIRR formula and reverted away from the standard IRR version. You could literally play with infinite scenarios at this point to see how it impacts the deal. Hopefully it's clear how powerful the XIRR formula is. Uneven cash flows, it doesn't matter. Inconsistency, not a problem. The IRR formula only is impactful if you have periodic annual cash flows. The XIRR, on the other hand, it can handle anything as long as you have a corresponding date with either a cash contribution or distribution. I hope the tutorial was straightforward. As a reminder, I also have a written version combining this video, solidifying it with the blog post from the tactical website. Should have you well on your way to being able to do these conversions and hopefully maximizing the XIRR for what I think is its biggest benefit, and that's reevaluating projects. If you've been enjoying these real estate analysis videos, I'd really appreciate if you give the video a like, follow along, and allow us to notify you when new content's released. Thanks a lot for watching, and we'll catch you next video.